Welcome to TheoTrade. This is Don Kaufman. Here we are. It is December 2nd, 2017, doing the weekend update here. You know, once in a while, the market reminds us what it is capable of doing. And I think that's the only way to really describe this past week of trade, where ultimately we see an explosion to the upside in the S&Ps. We see wild volatility ultimately on Friday, which I'll get into a little bit of detail on. On the flip side of things, though, if you're looking at a Nasdaq marketplace, the Nasdaq fell fairly hard during the week. In fact, I'm going to get into some of these divergences here momentarily. So let's start with a bit of a recap of some of the action we saw last week, but then again, not only what occurred, but what we can expect in the next few weeks of trade. Everybody's thinking, we're coming towards the end of the year, things are going to quiet down, and yet we're seeing quite the opposite. I think the place to begin this explanation here of markets would have to be by looking at expected moves, because I'm not sure everybody caught what amounted to, in my opinion, one of the most important things that we've seen in quite some time. And that happens to be here in the SPX. So I'm going to start with the SPX, and what you're looking at on the screen happen to be the expected moves. Now, for those of you that kind of tune in to the videos on a day-to-day basis, I talk about expected moves typically on a weekend update. And last weekend we talked about this coming week, which obviously this is the previous week, but the week was looking at about a $21 move higher or a $21 move lower. Okay, quite specifically here, we smoked the expected move. It was just about a 2 deviation move. Now, for those of you that speak, a little bit of trader geek, if you look at the expected move and it's $21 expected move, that means that's about a 1 standard deviation move. So we started the week out right around, 2600, 2602, and we explode to what? 2642. Now, okay, you can't even get this like more accurate. To almost the penny, we did 2 sigmas, which is 2 standard deviations. That is, if the expected move, and this stuff is important, and I'm going to show you why here momentarily, if the expected move is 21, all right, we roughly did just 2 times that. Obviously, it's about a $42 move to the upside, and ironically, that is exactly what we happen to effectively see. Now, kind of moving along with this. So we see this 2 sigma move to the upside. Great. You're like, Don, where are you going with this? I highlighted it. And the reason I highlighted it, it's the largest breach of expected move that we've actually seen since, okay, and we have to come back here on a big chart. It's the largest breach of expected move that we've seen since effectively December 7th, okay, of 2016. And this was actually a 3 sigma move, which was, again, if you had like an expected move of 20, this is a week that we ultimately move 60. However, and there's a big however to this, we see this big breach to the upside in the SPX, okay? Conversely, in the QQQ, what did we actually see? A very mild breach to the downside. And this is the one that, again, I don't think people necessarily caught this. The SPX breaks to the upside, so the S&Ps are on fire, yet the QQQ, which has been, the 5 stocks, the Microsoft, the Apple, the Facebook, the Google, the Amazon, and what we actually term those the monsters of tech, they're ultimately breaking to the downside. So a big divergence between the S&Ps and, of course, the Nasdaq. Last but not least on that front, you look over at something like the IWM that just throws off wild, insanely wild volatility on Friday. Nevertheless, if you take a look at the expected move here, we did, not have a breach of expected move in the IWM. After all that, the IWM smokes to the upside and literally closes on the edge of the expected move. Again, having a wild week of volatility throughout the course of the marketplace. So before I go into the Nasdaq and the S&Ps, again, we looked back at years of data, literally years of data, and I can't find any other instances where the S&Ps broke to the upside, okay, where we had the QQQ or the Nasdaq breaking the downside of the expected move. So consequently, you can expect more volatility this coming week, because once you start breaking, an upside and a downside, you're like, oh, that's great. Newsflash, why does that matter to me? It matters to you because it pulled the volatility up considerably. Now think about what we're talking about for just a moment here, and you're like, oh, okay, what are you talking about? Turning off the expected moves. We have a marketplace that rockets to the upside, yet we see volatility going higher, okay? Which is really in the opposing view of everything that you learn about a marketplace. Typically when markets go up, volatility effectively goes down. Here we have a market, exploding to the upside with increasing volatility. Now that should be, it's a shot across the bow. A lot of very experienced traders will tell you in the past when this goes on, it's a bit of a warning sign to overall markets. And quite frankly, we just haven't seen this in any recent trading, okay, where ultimately the S&P is to the upside, again, the Q is to the downside, and we're increasing in volatility. So how much are we actually increasing in terms of volatility? Well, this last week, as I said, had about a $21 expected move. What can we expect this coming week? That's where you want to go, and you want to look at the SPX. Okay, look at the SPX. Just go about a week out in time. The volatility is up to about 12%, and we're looking at about a $35 expected move. So what do you got? Well, the expected move now is, it's close to what? 70, 80% greater than it was in the previous trading week, right? So obviously volatility, it's near double where it was on the 1 week. If you go a little further out in time, again, volatility picked up though through and through. So I'll come back to that a bit. So now we're expecting, again, this coming week, a $35 expected move, which takes us just shy. It's about 26.77 all the way down to about 26.06. Okay, let's switch gears for a moment. I'm going to come back a little bit to the S&Ps here and expected moves in a moment. But we're going to switch gears and we're going to talk for a second about some of the volatility that we saw in the marketplace. Okay, as I started, with this weekend update, I said once in a while the marketplace kind of reminds you what it is capable of. And the reason I'm doing this is, is to scare you a little bit. Yeah, maybe, possibly. Okay, but I want to remind everybody that trades on an intraday basis or invest. I mean, you may have like a 401k and you're like, whatever. I never even look at the thing. Like, I totally get it. But I want to remind you what the market is capable of. And if you look at this candle, all right, just that one candle, I'll remind you, I'm on a 1 day, 1 minute. And that candle started right there. It's about the 34 level. Okay. And the candle ultimately ended right in this neighborhood here. And again, I'm going to give you specifics. We started at the 34 level. The end of the candle was the 18 level. People, that happens to be in the S&Ps a 16-point move. 16-point move inside of 1 minute, only, okay, to explode back up and get about 14 points of it back the very next minute. Okay, the minutes that followed thereafter, well, they got just as wild as we slipped all the way down to 26.05 before ultimately rebounding. Again, this is some of the news that ultimately broke on the trading session. It was a fairly docile day until ultimately we broke again. Think about this range. You're just shy of a 50-point S&P range. And the reason I'm bringing this up is because I want to remind you, we're not even talking here but a 1% decline in markets, and it felt like sheer panic. So I'll remind you what the market is capable of. 3% moves. And at the same time that everybody had their eyes on the S&Ps, they may have missed what occurred inside of the Russell, which became very quickly a bottomless pit of a 3% move. And we got to the edge of a 3% move inside of the Russell futures. Again, you're looking at this correctly. All right, we were trading at 1545 all the way down to 1494 in a very, very short span of time before ultimately rebounding out there. Again, as I said, once in a while the markets remind you what they're capable of, and you need to know that, especially if you trade on an intraday basis. But I'll also remind you, okay, that if you're an investor, you're not going to know fast enough to be able to get out of a position. So if you're somebody that wanted to hedge their positions, you need to be proactively doing that. All right, so let's describe what really went on now in markets throughout the course of the week. And when I say what went on, well, what did go on inside of markets? As we said, we saw the S&Ps, exploding to the upside over here while the Nasdaq is breaking down. It had to do with a massive rotation, okay? And that rotation had a tremendous amount to do with energy, okay? Obviously the financials exploding to the upside, and then the QQQ ultimately breaking to the downside. So I think one of the best ways to depict this to you, I set up a quick style in here where we're going to look at a comparison. And the comparison that we're looking at, and I'm going to make this abundantly clear here before I go any further, the comparison we're looking at is the XLE, which is the energy sector, okay, versus the XLF, which are the financials, versus the QQQ, which is just generally technology. And this chart happens to be, it's a 30-day 1 hour, and I took out all after hours trade to show you how wild of a, again, this monstrous divergence and rotation of capital happened to be. See, the technology sector, and again, I'm going to kind of highlight it right here. Here's tech, all right, there's the Qs. Technology sector is fairly massive. The assumption has been that if technology falls, it's going to take the rest of the marketplace with it, okay? Well, consequently, the financials are also a fairly massive sector. Here are the financials ripping to the upside. The financials unto themselves were not big enough, so quantitative traders go out. What do? They take financials to the upside, and they take energy to the upside. And if you actually look at the sectors themselves, okay, financials plus energy is equivalent and even larger than technology, okay? And what do we get? We get the QQQs break into the downside, yet we have what? The S&P flying to all-time highs over here. So again, this is the rotation. Now, the reason I'm just bringing this to your, attention over here is I don't think people recognized how large it happened to be. Again, on a percentage basis, all right, this happens to be the energy sector. This is just 1 week. I mean, the thing was down 12% end of the week, down 8%. That's a 5%, move in a really short period of time. And again, that's not from absolute high to absolute low. Flip it around over here to the XLF. And again, talk about like staggering moves. The financials throughout the course of the week, they started completely flat. They were up about 11%. When I say they started flat, they started off the week with absolutely no volatility. They were up about 11% year to date. They exploded. They're up 17% now year to date. Okay, talk about, I always talk about like statistically significant moves. I think that one isn't significant. All right, a 6% move up, okay, predicated on what? Now, here's the interesting aspect of the financials specifically. If you take a look at the financials, I'm going to drop to another style over here. I'm just going to look at the implied volatility. So here is what was ultimately shocking. You got a marketplace exploding to the upside, and this week it sparked incredibly high volatility. In fact, if you take a look at the XLF, the volatility is up to almost 23%. I don't think enough people are catching this stuff, okay? You got a marketplace that's ripping to the upside, and volatility is ripping to the upside. Again, when you first learn about options, you're like, well, when the market goes up, volatility inherently goes down. Yeah, unless, of course, the market explodes in a fever pitch to the upside and volatility also explodes to the upside. Okay, so the expected move for the next just 6 days, all right, this is next week, get a 70-cent expected move out there inside of the XLF. Now, there's obviously some growing concern on two fronts. So we see the XLF with its increased implied volatility, right? We see energy exploding to the upside. By the way, energy, okay? Energy also, you should kind of include the transports with that, because if you haven't looked at the transports on a percentage basis, nothing to me is more staggering than looking at these transports. This happened to be ultimately, okay, the week of trade, the transports, okay, were doing nothing. They were up 6% year to date and ended up the week almost 13%. Again, staggering moves that are happening in really, really short durations on increased implied volatility. Now, an area of concern, obviously everybody's looking at what we call the monsters of tech, right? So the monsters of tech, but this is the obvious. The monsters of tech have kind of a bad week. But a bad week, I mean, what does it do? It takes it back to where we were the previous week on a percentage basis. And you just have to put this into context here for a moment. On a percentage basis, okay, the monsters of tech, that's Facebook and Apple and Microsoft and Google and Amazon, oh my, they're up 42% year to date. And this is where you have to gain a little bit of perspective for a moment. You realize these things could drop, okay, easily 10%, and it would be like skinning the knee. But that would decimate, absolutely decimate the QQQs, a 10% decline. Do you realize that we could see the monsters of tech, and just bear with me here, just I'm throwing out numbers for a second, the monsters of tech could decline by the amount of 20%. And that would only take us back to midsummer, okay, movement. Meaning like literally a 20%, that would be, it's a full bear market decline. Yeah, but that only takes us back to where we were in July. There needs to be a serious wake-up call, because people are sitting here like, are we getting to bubble kind of levels? Okay, you know, you got your head turned towards Bitcoin looking there when you're missing the bigger picture, okay, in terms of percentage moves. These stocks are up 42%, okay, and are displaying signs of volatility. Now, in addition to it, emerging markets, I think a lot of people are also missing what's going on in the emerging markets. This coming week in emerging markets is going to be critical. The emerging markets, and I'll zoom back out here for a second, the emerging markets are also up about 30%, but there'll be something really, really clear about this. The emerging markets, it's really about Asia. This is not, you know, the emerging markets are like, well, what is emerging markets? It's China, it's Japan, it's Korea. That's the companies. If you look at the EEM, okay, and the companies that the EEM actually holds, again, it's Asian firms. And there feels, okay, real heavy in these Asian firms. And I've pointed this out, and I've actually got a short position on right now in the EEM. But I say that this coming week is critical because I believe that if we get right below the current levels, it is wide open for the downside there. And the EEM is aligning almost perfectly. Like if you look at some of the risk, all right, we'll come in here to the Hang Seng Index. It looks very, very similar. If you take a look at, you know, again, a number of, you know, the Shanghai Index looks fairly similar to the downside. Japan, by the way, I don't trust the Japanese market as far as you can throw it. These are the Japanese futures because this market is clearly and decisively supported by the Bank of Japan, also coming in just a bit. All right, so the EEM this week is of critical importance. Now, again, to leave you with this, all right, we've gone through a huge amount. The bonds, okay, we didn't even cover these, but they're elevated right now. So we have the bonds in an elevated stance, which is, you know, people talk about this quintessential risk on, risk off. When the bonds are elevated, that has been prototypically like risk off. That means the S&Ps are selling off. But the irony is bonds explode to the upside. Bonds explode to the upside on Friday, but then the XLF finishes up, but on an increased implied volatility. People, everything that we look at, all right, is it an absolute fever pitch? And you need to be aware of that moving forward into this week. You know, it was on Wednesday. It was on Wednesday where I said the next 48 hours are going to be pivotal trade. And it absolutely was pivotal trade. This next week, expect substantially more volatility. We're going to get some wild days of trade over here. Okay, put the news aside. Turn a blind eye to whatever's going on. You know, you got to listen to enough news about like Congress and the administration. Turn a blind eye to it. It's all priced in over here. Okay, you want the best indicator for the marketplace right now? I'll tell you what the best indicator is. Look at the weeklies inside of the SPX. They're going to tell you every step of the way. You realize you have almost a $20 expected move coming into Monday's expiration. The previous week, only had a $21 expected move. With that, thank you guys very much for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.